In the next 15 minutes, I want to highlight gold's rising role against two traditional, yet now openly broken pillars of the investing landscape, namely private equity and private credit. Now, over a year ago, I had warned of the open cracks in both private equity and private credit. I was not alone, nor was I sensationalizing a gold bug bias. By 2025, even the legendary bond king, Jeffrey Gundlach, had described private credit as the newest and most pernicious weapon of mass destruction facing our markets. As we look more closely at private equity and private credit, we discover not only their longer term implications for an already discredited global banking and currency system, but also the greater implications these wobbling private equity and private credit pillars will have on a rising gold price. Now, looking first at private equity, it may seem hard to imagine a decline in this otherwise powerful sector. When rates were low and money was free and liquid, the private equity space boomed with undeniably solid returns. During the first 25 years of the 21st century, the Cambridge Associates U.S. Private Equity Index confirmed an annualized net return of almost 13% in the private equity space. But as credit tightened in 2025 due to rising bond yields, liquidity began to dry up as well, as did the exit strategies for the big private equity players. Now, this turning point in the credit cycle mattered in a financial landscape where private equity valuations had risen by 24% just a year prior in 2024, and where the aggregate manpower behind the largest private equity firms, this is like Carlyle, KKR, Blackstone, etc., also served as the largest U.S. employers behind Walmart and Amazon. So private equity mattered. But to better understand how and why private equity had reached such a fatal turning point by 2025, it's essential to understand the larger macro setting for private equity's fall, as well as the basic private equity playbook, which was no longer functioning in this new, tighter credit cycle. Now, as to the macro setting for private equity's woes, we could, as usual, look toward the Federal Reserve. After years of printing money to the moon and compressing yields to the floor of history, private equity firms were desperately looking for yield in all the wrong places, namely cash-strapped businesses. And when rates were low, this made borrowing more attractive, but also more risky. Private equity firms would find wounded businesses, primarily in the retail space, and then use uber leverage, i.e. the easy money thanks to Greenspan, Bernanke, and Yellen's low-rate Fed punch bowl, to buy majority control of weakening businesses. Now, the fancy term for this was called a retail LBO, or retail leverage buyout. Thereafter, these not so benevolent PE partners forced many of those businesses to take on more debt to pay their private equity sponsors a series of painful dividends, which was good for private equity investors, but a fatal blow to many business owners. In such an easy credit environment, private equity sponsors were following effectively what was a five-act script. Now, the first act was that private equity firms invite their retail co-parties to take on more debt. In the second act, those PE firms then demand payouts, nicely described as dividends, from the companies they invested in. In the third act, many of those companies who are now forced to take on debt or issue junk bonds. These are retailers like J. Crew or Gymboree or Payless Shoes and Safeway, etc. These companies would eventually go into bankruptcy, which by Act 4, the retailers and the bonds you bought from them tanked or disappeared. While by Act 5, the private equity lenders or sponsors walked away from the bankruptcy courts with a legally restructured payout. In other words, a big fat profit. For years, this twisted game worked. Back in 2010, for example, retailers under the knife of their private equity owners issued over $90 billion in junk bonds and levered loans just to pay those special dividends to their private equity masters. Now, more than 20% of that $90 billion went straight into the balance sheets and pockets of the PE firms as what was called a carried interest. But the darker side of this private equity playbook meant that many retail borrowers and Main Street businesses had no chance against the much more capitalized private equity shops, who found perfectly legal ways to effectively strip mine struggling enterprises, plunder their cash flows, and then send their quote unquote partners into Chapter 11, where the PE sponsors profited even more. Now, this brings us all back to 2025 and its many warning signs for the private equity sector, a sector in which numerous family offices and other kind of smarter folks from the Harvard Endowment to nearly every mutual fund manager had found themselves. But as bond yields crept north at the same time that the greatest credit cycle, i.e., easy money, in the history of capital markets went from easy money to tight money, the false and illiquid valuations, then inflating increasingly illiquid and grossly overvalued PE balance sheets, would soon do what all bubbles do. That's pop. Now, private equity sponsors in 2025 were scurrying to liquidate their falsely valued holdings at massive discounts, at least for those funds lucky enough to even find a buyer at all. I recall many family office conferences in 2025, from Istanbul to London to Turkey, where family office principals were basically trying to sell their PE positions to anyone who would listen. Again, that was London, New York, Turkey, Germany. Everywhere I went, I would see private equity sponsors trying to sell their interests, or private equity owners, family offices trying to sell their interests as well. In short, the private equity sector, which thrived in artificially supported low rates, easy money, and bullish investors, was suddenly suffering a new setting where capital costs were rising, credit was tightening, and more private equity investors were sellers rather than buyers. 2025 was moving toward a macro environment wherein everyone from Warren Buffett and Jamie Dimon to the BRICS coalition, the IMF, and even the BIS knew that a credit cycle was ending, for the very simple reason that the US was objectively broke and that bond yields, the real cost of debt, were rising. Of course, these larger macro forces of tightening credit would have similar repercussions for the private credit space as well, kind of our next topic. But just what is private credit? In a nutshell, this multi-trillion dollar private credit market is an amalgam of private equity, venture capital, special purpose vehicles, money market, and hedge fund actors using massive turns of leverage to make risky loans to a predominantly unknown class of borrowers. I call this red flag number one. These private lenders also make loans with none of the capital requirements or deposit insurance or direct Fed access otherwise characteristic of and available to the allegedly safer and more regulated commercial banks. That's what I call red flag number two. Also, these private lenders were already seeing default rates creeping up from borrowers like Tricolor and First Brands Group and other subprime borrowers at alarming rates, reminiscent of those first defaulting subprime mortgage pools we saw in the pre-08 days. So that was red flag number three. Now, borrowers to these private creditors were unable to make their interest payments, and they were increasingly and really desperately offering equity instead of cash to cover their interest expenses. These are called payment in kind, or PIK payments, and those trends were an ominous signal of more default ahead. So that was red flag number four. But there was another larger yet more hidden red flag lurking behind kind of these PC curtains. Although these private credit lenders were by definition lending outside of the banking system, they were in fact getting a lot of their money from within the commercial banking system. In other words, by directly funding these private credit lenders, commercial banks were indirectly exposing themselves to the default risk of these non-bank lenders. And if you thought these private lenders were making safe and smart loans, well, you could think again. BlackRock, the largest and so-called smartest player of the global asset management universe, had its own massive private credit fund, the TCP Capital Fund. What few were noticing, however, was that by February of this year, 2026, the TCP Capital Fund had lost 1/5 of its value in just 90 days. And as of today, that fund is now gated. It means you can't get your money out if you're in there. That's another big red, or you could say black flag. So as the large and small players in this dangerously unregulated, hidden, and highly default exposed private credit market start to tumble one domino at a time, the commercial banks who seeded these private lenders become increasingly ripe for yet another '08-like moment of credit defaults from failed underwriting and reckless lending. In other words, we've seen this movie before. As with private equity, many of the private credit firms were valuing their loans on paper at much higher levels than they could actually sell these loans in any reality. Even worse, many of these loans or private credits were defaulting as fast as the PE-sponsored companies were going bankrupt. Now, the contagion effect of falling private credit loans, much like the contagion effect of falling mortgage pools and loans in 2008, will spread to the banks, thereby sending banking risk higher. And we all know how expensive it can be to bail out the banks, as we saw from the Lehman contagion in 2008 or the Signature Valley Bank disasters in 2023. Signature, First Republic, etc. The TARP and BTFP funds are very expensive to pay for. But drying liquidity at banks led by rising default risk at banks, inevitably means more liquidity to the banks in the form of reverse repo facility bailouts or now the more open QE at the Fed. But we also know that fake money and hence more mismanaged credit expansion just means a more diluted and debased US dollar. And a more debased US dollar just means more tailwinds for anti fiat assets like gold. Ironically, today, not even the big banks themselves can ignore gold. JP Morgan and Goldman Sachs have just quietly made their 2026 year end price targets for gold, and it's as high as 8,300. Now, a paper based monetary system is really hitting an historical turning point when even the too big to fail banks, who had deliberately downplayed gold for decades as a threat to the very monetary and credit systems which they helped create and then debase, when they're openly bullish on gold, that's a revolutionary signpost to me. Now, the two examples of the failing or wobbling private equity and private credit pillars of this old system are just two more equally compelling pieces of evidence that traditional systems are breaking. Meanwhile, gold does what it always does as debt driven credit and monetary systems fall. That is, it rises.